We're jumping straight into Datavault AI today. Everyone is watching the extreme volatility. I mean, we've seen these just intense 20, even 26% price surges recently. But the price action isn't the whole story. The real mission here is to understand how their patented portfolio, which combines blockchain and AI, is creating this new, really ambitious way to monetize real-world assets.
Okay.
We're talking everything from enterprise data to completely unique sports experiences.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
If you're enjoying the show, make sure to subscribe and hit the like button. It really helps the channel. And definitely let us know in the comments which stock you want us to simplify next.
All right, let's look at the bull and bear case for Datavault AI right now, because there's a really clear split in the narrative. You've got these immediate catalysts driving the bull case, but the long-term story, it really hinges on whether they can scale this unique tech faster than their burn rate.
Okay, let's unpack the bullish side first. Let's look at the core business. This isn't a single-trick pony, is it?
No, not at all. The company basically has 4 distinct revenue streams. You've got your high-performance computing, the HPC software licensing, then the Web 3.0 data management, and then the more specialized acoustic science and event analytics. That diversity is a big piece of the puzzle.
And one contract has moved the needle in a huge way.
In a huge way. The big catalyst was that deal with AP Global. We're talking a substantial $250,000 upfront payment, and that kicks off a 12-month deal to roll out their Santam infrastructure across 100 U.S. cities.
So wait, what exactly is Santam infrastructure, and why would a $250,000 payment cause a 26% spike? It seems disproportionate.
Well, Santam is their secured infrastructure for managing high-value data. It uses AI to, handle security and routing. For Datavault AI, this isn't just a pilot, it's a huge vote of confidence. A major client is paying a premium and committing to a year-long 100-city rollout. The market reads that as a massive validation of their whole business model.
That jump definitely points to the valuation argument. The market analysis we've looked at suggests that, even though it's trading around $1, Datavault AI might be drastically undervalued.
Right. Some models are putting a fair value on it of around $3.
$3. So that means it's trading at, what, a 66% discount right now? That's a compelling upside if the catalysts keep coming.
And the market seems to be buying into that potential. Technically speaking, the price action has been forming these higher highs after every piece of good news. That kind of pattern attracts momentum traders. You can see the retail accumulation lighting up on platforms like StockTwits.
You mentioned momentum. Let's talk about the technicals for a second. The data shows the 50-day moving average is closing in fast on the 200-day.
And that's a crucial event. When that faster 50-day crosses above the slower 200-day, traders call it a golden cross. Historically, it's seen as a major long-term bullish signal. It basically confirms that the recent momentum is real and sustained. For a stock like this, a microcap, a golden cross can be a huge green light for institutional buying.
Okay, so that's the market context. But here's where it gets really interesting for me. The competitive moat. I mean, technology gets copied so fast. If the whole thesis is hitting that $3 target, they need something that can't be imitated, right?
Absolutely. Their advantage isn't just having AI or using blockchain. It's the way their patented portfolio combines all of it. The AI, the digital twins, the blockchain, that synergy across different industries, from sports to fintech, that's the fortress they're building.
Let's drill down on that. The key technology seems to be this information data exchange platform, the IDE.
Yeah.
What does it do that creates such a high barrier to entry?
The IDE platform is essentially their proprietary engine for linking a real-world asset like a data packet or even a physical thing to the blockchain. Think of it like a digital title deed that can never be altered. It proves ownership. Because companies have to integrate the system deep into their own infrastructure, it creates these incredibly high switching costs. Once you're in, it's very hard to leave.
And they're not just hoping people don't copy it. They're bringing out the big guns, legally. Hiring a firm like Kasovitz LLP and Mark Kasovitz himself, that's not a cheap move. What does that signal to you?
It signals they are deadly serious about protecting this IP. I mean, when your whole valuation is built on your exclusive tech, you have to show you'll defend it. It's an insurance policy, but it's also a clear warning shot to any potential competitors. They are putting serious capital behind defending that IDE platform.
The IP is impressive, but it can sound a bit abstract. How does their tech actually combine things like AI and acoustics into a product someone would buy.
That's the really cool part. They have an acoustics division that measures unique sound signatures at events. They use that, along with their data science, to capture and analyze, let's say, the atmosphere of a moment. They create a digital twin of that experience, and that is what gets tokenized on the IDE platform.
Okay, give us that concrete example you mentioned, the tokenized autographs at Dream Bowl 14.
The tokenized autograph is the perfect proof of concept. It's not just a picture on a blockchain. It's a digital asset that could be tied to the signature, sure, but maybe also the acoustic and biometric data captured right when the athlete was signing it. By tokenizing that, they protect their piece of the pie in these huge growth areas like NIL name, image, and likeness monetization. It locks them in.
So if the tech is the foundation of the bull case, we have to look at what could crack that foundation. Let's step back. We have this bullish $3 target, but what's the bear case telling us?
The primary risk is, like with a lot of these aggressive growth companies, it's financial health. And we have to be candid here. The company is currently sustaining losses. That's not unusual, but they also have a really high price-to-sales ratio.
So that PS ratio raises some serious questions. Is the current price sustainable unless they hit that growth curve perfectly?
Exactly. The valuation models depend heavily on future revenue that, hasn't materialized yet.
Which brings us straight to the capital needs and the risk of dilution. They just issued 7.5 million shares to acquire more IP. That's an investment, but it's still dilution for current shareholders.
Precisely. And that concern gets worse when you look at the insider flow. Silex Holding, a former 10% owner, sold a pretty big block of shares, about $12.8 million worth, late last year.
Wait, hold on. If the fair value analysis is pointing to $3 and they just landed a client like AP Global, why would a major holder dump nearly $13 million in stock?
That's the million-dollar question, isn't it? It wasn't cluster selling where you see all the execs run for the door, but it signals one of two things. Either Silex just needed the cash for something else, or they have a much less optimistic view on that $3 valuation timeline. Either way, that's a lot of shares hitting the market, and it tells you dilution is a top concern here.
To be fair, though, we have to remember how scalable their model is. It's mostly software licensing. They aren't building giant factories. They're licensing intellectual property, which is a low-capital business model.
That low CapEx model is their big advantage against taking on debt. The blueprint is capital light. The challenge is just execution. Can they sign up enough big clients fast enough to get ahead of the losses?
Okay, so if they can manage the financials, what's coming up in the next, say, 1 to 3 months that could really move the needle? The calendar looks packed.
It is definitely packed, and that's driving a lot of the sentiment right now. First up is the warrant record date, January 7, 2026.
Okay, explain the warrants. They're exercisable at $5, which is way above the current price.
Right. So the warrants are basically options to buy the stock later at $5. The fact that the strike price is so high shows a lot of long-term bullishness. But in the short term, their existence creates volatility. The distribution of these things has been linked to those 20% price spikes before because it forces short sellers to adjust positions, creating some chaotic buying pressure.
Then right after that, they're on the huge stage at CES 2026.
Yes, a massive opportunity. They're showcasing their wireless audio and data platforms. This is where they could announce a major partnership deal.
And then the one everyone is watching, Dream Bowl 1/14 on January 11th, live on ESPN Plus Fay. This is where they're giving away 3,000 tokenized autographs. This seems like more than just marketing.
Oh, it's way more. This is the big proof of concept for their digital asset exchange. All the chatter online is focused on whether this event will finally unlock their proprietary NIL trading exchange. It's a huge catalyst.
Speaking of attracting attention, we should probably touch on those non-traditional shareholder returns. The meme coins.
It's a very unusual strategy, yeah. They gave out one Dream Bowl meme coin 2-second token for every 60 shares. It's basically a non-cash marketing tool, but it attracts a certain kind of speculative investor. It's a way to use their own Web 3.0 tech to create buzz around owning the stock itself.
And if you zoom out, the macro environment is pretty friendly for this kind of play, isn't it?
Absolutely. We're seeing sector rotation back into AI and blockchain, and any expectation of future rate cuts makes aggressive growth stocks like Datavault AI more attractive. Lower rates just make that future potential worth more today.
So when you put all these complex pieces together, what's the takeaway? It looks like the company is positioned as a high-stakes, high-reward swing trade. It's driven by these huge near-term catalysts, the warrants, CES, the Dream Bowl, all in the next 90 days. But at the same time, it has this genuine multi-year potential if that IDE platform becomes dominant. The bull case is all about perfect execution. The bear case is simply about dilution and that high valuation. So here's a final thought for you to consider. Given how much of their value rests on tokenizing real-world assets, how much of that jump from $1 to a potential $3 rests on making the idea of a tokenized autograph an indispensable technology and not just a very cool but ultimately niche event marketing tool? That's the question. That's the lowdown on Datavault AI for today. If you haven't already, subscribe so you don't miss our next breakdown. We'll catch you on the next one.